Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would instantly, I would do far better percentage-wise if I were working with small sums. There are just way more opportunities.
Hey YouTube, today I wanted to do a breakdown of G3 stock. I recently made G3 stock 35% of my entire portfolio, and I want to explain why. It is my thesis that G3 is the best value out of every single security that I've gone through in the market. And in this video, we're going to do a full financial breakdown of the business, its current valuation, and why I feel like it's trading at an enormous discount to its true intrinsic value. So to start, I want to talk about how I found G3. Off of the recommendation of great investors like Graham and Buffett, I spent a lot of time searching and sifting through small securities, and I looked for things that traded at a large discount to their shareholder equity, because I believe it's in that realm of businesses where you can find things that are wonderful opportunities, things that trade at discounts to their intrinsic value that are enormous. Whereas in the world of large securities, it's very difficult to find things that trade at enormous discounts to their equity. You're most likely almost always in the world of large securities looking for things that have to grow into itself. There are very few stocks that the common investor would call value stocks in the world of large securities that are extremely mispriced relative to their earnings or book value. But as you get smaller and smaller and smaller, and as you go down the lists, as you go A to Z, you will find things that really pop out of the page at you. And so for me, I felt that more than any other security in the market, G3 popped out of the page at me. And as I've done more research about the business and as I've looked through the financials, it continues to pop out to me. I first opened a position in G3 when the stock fell in value in late September. I bought consistently for a couple of weeks, and I averaged buying at about a $775 million market cap at the time. My theory was that the stock was worth at least double that on a conservative basis. And at the time, I made G3 a very significant part of my portfolio. I'd have to look back, but it would have been right about 25% of my portfolio at the time. And so as the next month moved on, as October unfolded, G3 stock went up very rapidly, and so I stopped purchasing. It went up to about a $1 to $1.1 billion market cap. But then, in one of the most shocking drops I've ever seen in the stock market, G3 dropped 45% in a single day, a record for their business in its 30-plus year history. And the report or the thesis for why it dropped so much, if you were to ask the news, is that PVH came out and said that they're going to bring the Calvin Klein license back in-house instead of allowing G3 to license their products, which takes up a significant portion of G3's revenues. But at the same time, PVH agreed that the licenses would be extended from 2025 all the way up to 2027. And so G3 at the same time came out with an earnings report that most analysts viewed as a disappointment. And I will admit myself as a shareholder that the earnings were a disappointment. However, the drop in share price, the 45% drop in share price, is irrational and it's unreasonable considering the situation, and it is a very large overreaction in my opinion. And the day after the 45% drop, I started accumulating more shares at about $12 a share. And so to start, guys, I wanted to look at the shareholder equity and the balance sheet of the business. And it is my thesis that while currently trading at a $600 million market cap, that this stock, just in terms of what they have accumulated in retained earnings and in equity, that just that alone should be worth at least $1.4 billion. And so that is the strongest part of my thesis, is the fact that the stock is currently trading at 0.37 book value. And it is my firm belief that they have a very clean balance sheet too. And so if we look at the assets and liabilities to start, you can see that G3 for the last 4 or 5 years or so has held about $2.7 million worth of assets. And in terms of liabilities, they've held anywhere between $1 billion and $1.5 billion worth of liabilities, which is a very good ratio when you compare it to businesses like Macy's or other big retailers. As well, when you look at their shareholder equity and how their shareholder equity responds in times where they could write off their inventory, for example, I really like what I see. I see a business that doesn't take a whole lot of risks in terms of how they value their assets. I think I see a business that values their assets correctly. I think I see a business that looks at their goodwill and intangible assets correctly, which is a very important part of looking at a balance sheet. And so let's look at the 10Q. And so if we take a look here at the 10Q, we can see we have the current assets and the assets for the month ending July 31st compared to the year before that and then the start of the year. And so if we look at their total current assets, we've got their cash, accounts receivable, inventories, expenses, and prepaid taxes. And we come out with $1.7 billion worth of current assets. And now we're going to look at their other assets. And this is where it gets a bit more tricky when you look at businesses, is what they report in terms of value for alternate assets like goodwill or intangibles. And so to start here, we have investments in unconsolidated affiliates. We have property and equipment, net. We have operating lease agreements, valued as assets. We have other assets, undefined. We have other intangibles, net. We have trademarks, and then we have goodwill. And so if we look at this, one thing I want to say right away is that this business, G3, they did not carry much intangibles until recently because they've been in an acquiring spree for businesses. And so as you can see, just the year before, they only had about 720 million in intangible assets, whereas this year they have 920 million. And so when you look at intangible assets, I always feel that this is the most important part of a balance sheet, is trying to understand what they're worth. Because most commonly, businesses do not consistently value or revalue their intangible assets. They'll purchase, they'll write off the purchase price of something, not write off, but they'll write it on their balance sheet as a goodwill or intangible asset. And then they won't change the price as the potential value of that asset changes. They'll just keep it the same. And so it's always good to have intangible assets that have been recently acquired, because it's much more likely that they're worth about what they paid for if it's been recent versus a long time ago. And so that's one thing I like a lot. And when I go through securities, I always try to think about what would happen if their inventories were worth 1/2 of what they're written as on the balance sheet. I always try to think about what would happen if their intangible assets were worth 1/2 of what they're reported as. And when you look at a lot of businesses, you would realize that a lot of businesses are nothing without the value of the intangibles. And that a lot of businesses would carry negative equity, and that's how businesses hide their actual earnings. It's in intangible assets by not writing off what they're actually not worth anymore. But when I look at G3, the brands that they're purchasing, brands such as Karl Lagerfeld, Carl Perry, G.H. Bass, Donna Karan, Bass, Andrew Mark, Cole Haan, Wilson's, etc., etc. This is what makes up the Goodwill and the Intangible, or these brand names. It's very difficult to understand exactly what they're worth, but as an investor, I can get a good idea. And in my framework, I have a feeling that these trademarks are worth as much as they've paid for them. Because these, in most part, are businesses that have grown in terms of sales. And these are businesses that G3 has used to grow market share. And that's sort of G3's strategy, is to acquire new businesses to grow market share using brand names. And so when we look at their assets in total, their inventories, for example, they didn't write down almost anything during COVID. And when you look back and you read through their reports for what happened to the business in 2008, 2009, they didn't write off almost any inventories then either, which gives me a good feeling as an investor, because what you need to be worried about is the chance that they write off their inventory as not being worth as much as it's been valued as. But with G3, I get a good feeling about what they're valuing the assets for, what they're valuing the inventories, the goodwill, and the trademarks, which takes up a very large part of the total equity. So as an investor, you don't have to be wonderful at understanding every line, but you have to have a good framework for understanding what things could possibly be worth if they're not worth what they're reported on here. And so when we look at their debt to equity, for example, they have $1.6 billion worth of equity. They've got over $1 billion worth of retained earnings, $1.2 billion worth of retained earnings. And they've got only $1.5 billion in liabilities. This business, compared to all other businesses in the market, is extremely well leveraged in terms of debt to equity. It feels extremely safe, and it feels robust. The second large part of my thesis on G3 has to do with past and future profitability. And so if we look at the financials, if we look at the earnings for the last 10 years, you'll see that they've grown revenues quite tremendously. Back in 2010, they were doing about $800 million worth of revenue. And now today, they run an annualized run rate of about $3.2 billion. And so if we take a look at the net income, this is a business that has generated over $1 billion worth of accumulated earnings. They don't pay a dividend. They started making over $100 million worth of net income back in 2014 on only on about $2 billion worth of sales. And they did wonderfully after COVID. with record high margins, increasing net income to about $220 million. And right now at this moment, trading at a $600 million market cap, G3 is trading for about 3 times trailing earnings. In the latest quarterly report, the CEO, Morris Goldfarb, has said that he believes that the business will generate $150 million worth of net income over the next 12 months, even with inventory challenges, having too much inventory in their warehouses, and with inflation issues, consumer demand issues, and logistic issues. He still believes that the company will profit the equivalent of about 1/4 of the current market cap. Understanding the G3 PVH relationship is key in order to be an investor in either of these businesses. So PVH owns the Calvin Klein brand, for example, and other brands that they license to G3, so that G3 can sell these brands with the Calvin Klein name on them. And so G3 built this model, this licensing model, from when PVH and them first decided to do business in 2005. And so up till today, licensing through PVH and their brands is about 45% of all of the revenue that G3 does. And with PVH saying that they want to transition the licenses back into their own business by 2027, it has worried investors in G3 that this business will not earn the type of money that it's earned in the past, in the future. It is my belief that even with the take back of the licenses, that this is still a stock that trades at a ridiculous discount to intrinsic value. And even with that factored in, I still believe that this is the cheapest stock in the market. Because PVH is not everything that G3 does. G3 does a lot of other licensing and has the capability to find other brands to license for. And that's what they're going to do according to Morris Goldfarb. He believes that the licensing change is something that won't hurt G3 in the long run. And I agree, and I see why. And it's because G3 is not a business that's always relied on PVH. It's sort of something that happened as chance and circumstance. But G3 is a very adaptable business. It's a model that can be taken to other brands. And I promise that Morris Goldfarb will find other brands to license for. Calvin Klein is not the only name in town. There are lots of other brands that G3 can license for. And at the same time, G3 has shown itself in the past to have a tremendous ability to grow its own brands. And that's half of G3's revenue is their own brands. And if we think back to how much net income G3 was able to generate on 1/2 of the sales that they currently do today, even if you took 1/2 of the revenue away today, instead of waiting for the licenses to expire in 2025 through 2027, even if you did that today, I would still argue that G3 is a wonderful stock at current prices. But then when you take into account that for the next 3 years, they'll still be able to license everything that they're currently licensing, with some of the licenses extending through 2027, it's fair to think that they're going to generate at least $150 million worth of net income over the next 3 years in the same way that they have while growing their other businesses. And that appears to be the plan. It appears that they're going to transition into their own brands more than they ever have before and away from the licensing model. which is something that shareholders value more in all businesses. And so it's my opinion, it's my strong opinion, that even with all of these considerations, G3 is still the best deal in the market. It is completely irrational for something like this to be trading at 0.37 book value, or a $600 million market cap with 1.6 billion in shareholder equity. And my next point has to do with redistributing cash. And so, as G3 is not a business that distributes a dividend, G3 is a business that purchases shares, but only at the most opportune moments. Morris will only repurchase shares when he feels the stock is below intrinsic value. And so Morris has purchased about 3% of the shares this year in the first 2 quarters. And this is significant because with the price of G3 now fallen down to about a $600 million market cap, I expect the buybacks to increase. And even if they don't increase in total volume, the amount of shares that they buy back at a low price will increase with how low the price is. Like I said before, this security truly pops off the page at me, like nothing else does in the entire market. And I've looked through hundreds and hundreds of potential securities for opportunities like this one. And so to end and to conclude, I wanted to just do a quick fair value estimate or range for what I think the business is worth right now. And so right now, considering the fact that they have 1.6 billion in shareholder equity, I project that they're going to make about 150 million this year. And I project that the business will continue to grow at small rates before the licensing change. I think that the business is worth between a $1.5 billion market cap and a $1.7 billion market cap, or about 10 times projected 12-month earnings. In terms of trailing earnings, that puts it at about 8 times earnings stock. And so one thing I'd like to make clear about this business is that this is not a business that compounds at 30% a year. This is not a wonderful, amazing business. This is a business that compounds at an average to above average rate, in my opinion. But it's one that sells at such a discount to its intrinsic value that its path back to intrinsic value is worth purchasing to me. And not just worth purchasing, but it's the best deal to me in the whole market. And this sort of idea, the idea of buying a stock that is extremely beaten down and discounted, and then selling it when it goes back to intrinsic value, that's called cigar butt investing. And so I feel like I'm channeling Walter Schloss with this investment. I feel like I'm buying a business that's worth 37 cents on the dollar, but and it's something that I don't have to expect to profit a whole lot. And it's something that I can't find anywhere else. It's really a unique opportunity, which is what Walter Schloss looked for. And I'm interested in buying more of this stock. At a current $600 million market cap and with a good balance sheet, I truly believe that as the most mispriced security in the whole market, that I would be willing to make this 50% of my entire portfolio if it got cheap enough. I am comfortable doing that because I'm comfortable with the level of analysis that I can do on a stock. And it may not be something that I would do with other people's money. Putting 50% of other people's money on one security is not okay to me. But putting my own money in my own portfolio, which is not my entire net worth, is acceptable to me. And is something that I'm willing to risk for something like this. Thank you for watching.